So tell us, I mean, if you're an options trader, how are you seeing all these different moves? Bond yields declining, the market moving, churning downward. As an options trader, what does that say to you?
Well, certainly the way the movement in the bond market has been and the way the liquidity is moving in this market on a day-to-day basis, we're seeing the market move and swing, have these more than 1% daily moves. And so as an options trader, I'm looking at what the VIX is doing in volatility, and I'm seeing that lack of liquidity right now. And it seems like there's this rush into the 10-year note, into longer dated treasuries all of a sudden that has completely shifted from where we were last year and this more conservative route to the market. And so as an option trader, I'm seeing more heightened volatility, and I want to play that from the long side and not be a short options trader in this type of environment, but rather one that buys options, whether that's a put for protecting my portfolio or buying a call to play to the upside.
I think it's interesting you said you don't want to be a short options trader right now. Last week, we actually had some data from S3 Partners that shorts against the SPY and the S&P 500 were rising, even though the market was going down, which was pretty rare. A lot of people were, I guess, concerned about the jobs report. Now that we're past the jobs report, is there another event that a lot of people are trying to protect themselves from when it comes to options? We have Apple today. We have CPI later this week.
Yeah, we do. We have a couple big events for sure this week. And when you look at some of the events coming up, really, the jobs is so critical right now because as we sort of seen this yield curve flip, and we brought up here the 10-year note and where that was trading interest rate wise, as that flips, the market tends to get very volatile after being in this environment where we've had this inverted yield curve. And so I'm looking at the events of not only the Federal Reserve decisions coming up in the coming months, but the unemployment reports both in October and November. And then you couple that with an election year that we have in November, and it's going to make for a very volatile October and November timeframe here. And so lots of data to digest, but that's going to lead to some volatility. And the unemployment report basically, yes, it was 4.2%. So that was actually pretty good because now we think it maybe has stabilized a little bit. Let's get a couple more months of sideways movement in the unemployment report, maybe even lower, and then that will kind of navigate us out of these volatile environments.
Well, I mean, the unemployment report, CPI, all these things are important because we think it's going to give us insight into the Fed's decision coming up next week. So as an options trader, do you have to prepare for that or protect yourself for that? Are you concerned that maybe all the gains from a cut is already baked into the market?
Yeah, I'm definitely, when I'm looking at it for clients right now, I am looking to be a little bit more tentative and a little bit more protective in the sense that, look, the market's had such a wild ride to the upside over the last couple of years here. Maybe it's time to take a little bit of profit, limit some of the risk. So as an option trader, what I'll look to do is any underlying that I'm long the market, let's say the S&P 500, rather than own something like an SPY ETF, I would rather own a call option, slightly to the upside at this environment, just risk the level of premium of that call value. And that's all I have to risk. And then if the market rips back higher, I'm back in the market. I can exercise my call. I can get back into the market. But I'd rather use options from the long side here rather than being naked long this market right now.